finances, investing, estate and retirement planning? Well, I went to school so you don't have to. Welcome to Finances and Inflation. Finances and, in conjunction with my company, Capital Coaching, helps people achieve their financial goals through personal, tailored, and attentive financial coaching services. I create successful financial plans by examining your spending and saving habits and then guiding and educating you to your own personal success. Coaching services include evaluation of your spending plan, building your savings, financing your retirement, examining your insurance needs, and planning for your own individual goals. Please contact me at capitalcoaching.net to make an appointment for your free consultation. The Fed members, or 12 out of 18 of them, stated this week that they expect to have 3 rate raises in 2022, making money more difficult to obtain, effectively lowering the supply of money in the United States. Jerome Powell of the Federal Reserve shared that in the short, medium, and long term, rates will rise by 0.25% each time. 5 of the Feds expect 2 of these rate hikes will occur. This means that interest rates will rise and the cost of borrowing money will rise with it. The central bank sets the rate that banks borrow from each other will increase as well, and that means that we, the consumers, will pay more to borrow money. They raise the rate when inflation starts to creep up, like it's doing right now. But as interest rates rise, people borrow less money and the demand for goods and services drops. Less disposable income equals less spending for many people. And what does that mean for you? Mortgage rates have risen from 3.24 on a 30-year loan and will continue to rise in 2022. That alone is equal to about $135 a month or $1,620 a year, or over the 30 years, about $48,600. These numbers are for 30-year fixed loans, and those with adjustable rates or home equity lines of credit, HELOCs, that move with the prime rate can expect to pay more soon. So refinance sooner than later. HELOCs are more closely influenced by prime rates than mortgages are, so those in particular are affected. Rates tied to credit cards will generally rise with the Fed's increase if you have a variable interest rate. This means that you'll want to make paying down this debt a priority so you don't get caught owing even more this season of giving. If you take $5,000 at, say, somewhere between 19 to 20%, you can owe an additional $70 to $80 for a 1-point rise in your interest rate. Matt Schultz of Lending Tree says it might not sound like a lot to some people, but when you're living paycheck to paycheck, trying to knock down that debt really does matter. Basically, small increments do add up. Carefully consider a 0% transfer balance card that charges no interest rate for 15 to 20 months so that you can pay down a credit card and owe no more in interest. The Washington Post says to consider the hit to your credit score and balance it against being able to get out from under any double-digit debt. But watch out. Don't consider it another source of credit and spend up again on the old card. Car prices are up about 31% for used cars and 11% for new ones. The selection is limited and supply chain issues are not helping. Chief Financial Analyst at Bankrate, Greg McBride, warns that taking care of your credit to keep it up allows you to get the best deal on a vehicle and financing. Bankrate says that auto loan rates are dictated by the time of year, the type of vehicle, and the borrower's credit score. So although the Fed affects the rate that banks lend each other money, your own financial history will be the biggest determinant. Your savings and certificate of deposits, CDs, or sometimes called share certificates by credit unions, will rejoice when rates go up. CDs and share certificates benefit from the rate hikes because the higher the prime rate goes, this is what the rate set by the Fed is called, the more banks will pay to borrow your money. When you put your money in a CD, they can lend out this money, and with higher federal rates, they can charge more and keep or gain your business as they pass on some of what they've gained to you, the banking customer. The longer you let them borrow your money, the more they'll pay in a higher interest rate. In some cases, banks may offer a one-time bump up if rates increase during the time you hold your CD. These CDs may pay a little bit less than fixed-rate CDs, but if you believe the rates will go up, it might be worth it to you. Similarly, you could purchase a step-up certificate that has a built-in predictable rate increase at regular intervals. Talk to your lender about all of these options when you have the money to save for 3 to 5 years. This little bit of effort, comparing savings vehicles across a couple of lenders, will grow your money to a better rate than a savings account can. Stock prices could start to fall if people and companies don't have as much disposable income to spend, because they cut back and start to slow down spending on the extras like stocks. Conversely, bonds rise during a time of the stock market slowdown. This is because as interest rates rise, bond prices fall, but as interest rates fall, bond prices rise, making them more desirable. However, all the adjustments that the Federal Reserve Board makes takes about 12 months for the effects of this increase to really be felt. Interest rates rising can mean less money in a consumer's pocket, either because they have less to spend on the items they want to buy, or items just cost more. Lower interest rates mean that the typical dividend-paying sector, like utilities and REITs, real estate investment trusts, do better, as well as large, stable companies. Other sectors like financial industries, banks, mortgage lenders, and insurance companies earn more as interest rates rise. As other companies cut back on spending, they make less profit and stock prices fall as consumers don't see a big return on the stock they hold. And as many companies experience the same fall at the same time, that means the market can go down. But this is exactly why holding on to a stock of a good company and waiting for the price to rise again is so important. It's also a great time to buy stocks as they're effectively on sale as the prices go down. Interest rates rising is typical in financial cycles. We've had a long period of time when stocks rose and people made money on them. It's expected that inflation ebbs and flows, so being ready with your savings and making sure that your portfolio includes stocks and bonds, or TIPS, Treasury Inflation Protected Securities, to safeguard your investments. This can be done with TIPS mutual funds or TIPS exchange traded funds. They're not sexy, they're not fast money makers, but they do help provide money growth when stocks are taking a fall. Inflation is not a time to panic, but it is a time to evaluate what you need to spend your money on versus what you want to spend your money on. Let's face it, that's not really a bad thing, is it? Thanks for listening to Finances and Inflation. We know you chose to listen and we're grateful. If you enjoyed this episode, please follow or subscribe for free in your podcast provider and share your favorite episode with a friend. Consider leaving a review because it brings financial education to others and it helps people find us more easily. Please let me know what questions you'd like answered or any topics you'd like me to cover by going to the website at financesand.net and leaving a message. You can also contact Capital Coaching for your own personal financial needs at capitalcoaching.net. Finances and does not provide tax or legal advice, and nothing in this podcast is to be construed as such. Always consult a tax, accounting, or legal professional for advice on your specific situation. Remember, I went to school, so you don't have to.